We are now beginning our studies in liabilities. So, as I alluded to earlier, we start with liabilities and then toward the end we go into equity, and then we have a few odds and ends to put in there. And hopefully, when we've completed our studies this semester, we have created a conceptual balance sheet so we understand where all the numbers are coming from in the balance sheet and also how the balance sheet changes over time. So this is chapter 13 and the title of the chapter is on current liabilities and contingencies. I would say about this chapter that we are really also introducing you to an expanded version of what a liability is. So you should pay attention this semester to the definition of a liability. If you understand that definition and if you understand the theory behind accounting, then when you're in the profession and someone brings to you a transaction, you'll have an idea of how it can be recorded. So instead of memorizing the debit, memorizing the credit, when you get through with your intermediate accounting classes, you have an understanding of theory and you can apply the theory to any transaction and say, hey, that's a liability, or hey, that's equity, or this is how I remember we expense off an asset if it were intermediate accounting 1. So assets and liabilities, by the way, are opposites, and it's very helpful if you look at it this way because assets will have value to the company, and generally a company wants to have assets. They're a good thing. Let's pump up those assets. Let's make the assets look good is a motivation that companies have. Assets represent future inflows. In the case of cash, which is an asset, you can see that you can use cash in many ways and that it provides a benefit to you that's into the future that will create a future inflow. And then assets, of course, are owned by the company, and that ownership is very apparent. You know that consigned inventory, or you should have learned this from Intermediate 1, that inventory that's consigned, you are holding, that's owned by someone else, you don't include in your balance sheet. So it's a part of the ownership aspect of assets, but also when we look at liabilities and consider them as opposites, we can address that as well, because if you look to the right, liabilities are technically owned by others, or the rights that are owned by others. So when you have a liability and when you record a liability, that represents something that someone else can collect from you, whether it's in cash or whether it's in services. It's just something that represents an amount that you are going to owe to them. Along the lines of this, you're thinking along the terms of contractual liabilities if you want to look at the legal aspect of this. Whereas assets will give you future inflows, liabilities are going to represent future outflows. And the reasons why we don't call this future cash payments is because the outflow does not have to be in cash form. It can be in other form. And liabilities have value to outsiders and not value to us. And so whereas we were talking about assets, we said we want to pump those up. When we have liabilities, we want to compress them or push them down and make them show as being smaller on our balance sheet. So when you look at this, assets and liabilities are equity. Liabilities are opposites. I said equity because I want to make the point that equity doesn't really fit into this scenario. Assets and liabilities, we have those and we can see that they're opposites, but equity becomes a bit of a hodgepodge. So at the end of the semester or toward the end when we start talking about equity, that will all make sense to you. For now, we're talking about liabilities, which are opposites of assets. So in this, we are going to learn what a liability is. We just had a brief introduction to it. And then we're going to talk about current and long term. We have vacation days, warranties, and gift cards. Well, because this is in the chapter on liabilities, our introduction to liabilities, we know that these are going to be liabilities. But they are not necessarily current liabilities, and we'll talk about that. On 3, the issuance of notes receivable, I should say the issuance of notes payable, is going to be handled the same as a note receivable seen from the other side. So when you were in Intermediate Accounting 1 and you had notes receivable and you talked about that valuation when you did your first journal entry, and by the way, when we do the first journal entry on an account or an item, we call that recognition, so I'll be using that word this semester. When we recognize a note receivable or a note payable, and when we record the interest on these notes, receivables or payables, we are going to use the same basic principles. On 4, a contingency. You may or may not have discussed this at all in Intermediate Accounting 1 or in financial reporting, your introductory class. But a contingency is something that could occur. The common definition of contingency that you may know in your general vocabulary, it's very similar to that. However, this takes an accounting spin. So it's something that can happen, and when it happens, because it's in the liability chapter, you can say it's a contingency that's going to create a liability. So when you have a contingency that can create a liability, what do you do? And then what if more information becomes known toward the end before your financials are issued? What do you do? These are the 4 major learning objectives. So this PowerPoint is really concepts, but I'll start talking about some problems in it. And then you should go and you should work in your SMART book. It was formerly called Learn Smart. So if you're in Connect and you are familiar with Learn Smart, now the phrasing is the SMART book. And after this, you should do that. This is the all-important definition. The other slide just gave you a conceptual notion of where we are, that assets are opposites of liabilities. Liabilities are opposites of assets. But what is a liability? If you want to use mnemonics and understand this and say for probable it's a P and for sacrifices that letter is an S, it's fine. The main thing is there's 3 parts. And if you look at the first one, it says future in it. If you look at the second one, it says current or present. And if you look at the third one, it says past. So some of you are aware of the Christmas play and the Christmas movie, and you understand the ghost of the future and the present and the past and all that. It's like that. There's a past, there's a present, there's a future. And these are 3 aspects that the liability has to have. So to call it a liability, which means to do the recognition, which means to do the journal entry that gets it on your books, you've got to have these 3 things, and they relate to the past, the present, and the future. And so in the future, we've already talked about that. In the future, you are going to have to do some outflow, and we call this a sacrifice. You're going to have to give up something in the future. So before you do a journal entry, you have to say, am I going to have to do something in the future? And the probable we'll talk about more, but it means it looks highly likely that you are going to have to give up something in the future. So we'll get into the terminology, but it's not a remote thing. It's something that, you know, if you're a gambling person, you would say, I think we're going to have to do something in the future. So that's the probable part, probable sacrifices in the future. Again, relates back to that outflow term. And it is a result of current or present obligations, and I say commitment to others. Goes back to what we were talking about, liabilities. There is something that is of a contractual nature And it doesn't have to be an explicit contract. It can be an implicit contract, so it doesn't have to be written down. But there is this notion that you owe, okay? You owe outside the company. Could be to your employees, it could be to vendors, but you owe, okay, to someone outside. And then the third one is a result of past transactions. So the last one is probably the most difficult thing for you to think about, but here is an example. You go out and you buy inventory, and you put the inventory on account. Well, what will you have to do in the future? In the future, you're expected to pay it off, right? And at present, if you take this inventory, when you receive it in, what do you have? You have an obligation to pay for it in the future because you've received it in, right? And then on the third one, what about the past transactions? Well, the past transaction was the relationship you had with the vendor that said, I'm ordering this from you and you are going to deliver it to me. Something happened, not today perhaps when you're doing your journal entry, but something has happened that sets it all up. So that's the third part. Now when we talk about current versus non-current, current liabilities go away in the near future, which is within the operating cycle, and if you want to look up that definition, fine. I'm going to say in this class to simplify our life because all businesses are different. All businesses have different lengths of operating cycles depending on what they do. We will say 12 months. So just a general rule, 12 months. So current versus non-current is 12 months. And I will make it quite clear to you. So if I say 18 months, you're going to say that's not going to go away in the near future because it's 18. If I say 9, you say it's going to go away in the near future. Therefore, it's current. Investors are interested in current assets and current liabilities. This goes through on the quick ratio, and there's an acid test ratio. You have a brief understanding of those. I'm not covering it this semester. The point I'm making is it really does matter which category you put them in when you do your financials. Current liabilities, here are a few examples. Accounts payable, trade notes payable. And again, for this class, it'd be a 12-month thing. And short-term notes payable, 12 months, yes. Accrued liabilities, we need a little description here because only if they're expected to go away in that current time period or the operating cycle for us 12 months. So you can have accrued liabilities, a portion of which is long-term or non-current is the other phrase for that, and a portion of it is current. Now, along those same lines, if you have long-term debt, including bonds, that need to be paid off, which is going to be the topic of the next module, when you have these things, you need to set it apart and say, how much do I have to pay within the next year? And if zero amount of that long-term debt is to be paid off, and I'm talking about the principal, I'm not talking about interest, if zero amount of that liability goes away within the next year, then zero amount of it is current. However, if you have a bond or if you have some sort of a financial instrument where you're going to be paying off part of it within the next year, within the next 3 months, whatever, that part of it needs to be separated out when you do the financials. Okay, so the accrued liabilities up here, I said sometimes need to be separated. It's within the financial statements. When you do your initial journal entry, you are going to record a liability in one journal entry. It's when you do the financial statements. When you do those, you need to take that one account and you need to split it and show it separately in the financial statement. So the overriding criteria, got a star by this, must be important, that classifies the liability current, is that it will go away in a current operating cycle. For most companies, it's a year, and we are going to use that convention of a year just to simplify our lives. Accrued liabilities. Now this slide is being cut out to the very bottom line of it. And I will say at the bottom, it says, here are some examples of accrued liabilities that are not current for employees. Vacation, the next line, days, sick days, paid absences. As long as we have a probable and reasonably estimated event, we need to make accruals. So it's unfortunate that all of this can't fit on our screen when we do our recordings, but that is the way it is. The point I want you to see in this is some new terminology concerning liabilities, which is probable, I spoke of that briefly, and reasonably estimated. Accrued liabilities include things like interest expense, salary expense. You know that this happens at the end of a year and the end of a financial reporting period where you do a journal entry that's a salary expense, and then there is a salary payable, and you have possibly some deductions in there when you do that journal entry. You should have had that probably from Accounting 201. Rent expense, and then the other side to that would be a payable. So accrued liabilities, a typical thing is going to be a payable. Not always, and by the way, when you see the word payable, it means a cash payment is usually involved. So that's kind of another interesting terminology we have within liabilities. Payable usually infers there's going to be a cash payment in the future. As long as we have probable and reasonably estimated events, it means we can come up with a number, then you will be doing a journal entry which will recognize the accrued liability. Product warranties. Some textbooks will show this as a contingency. I don't like it, and we'll talk about contingencies later on, but there's a difference between a contingency and a necessary accrual. In a necessary accrual, you are going to have to accrue some amount just as a normal course of business. It's what you do, okay? So if you have a business and you're selling products and you are making a statement to the customer when they purchase it that if something goes wrong within the year, you can bring it back to us and we will fix it. Well, there are not going to be all the products returned, obviously. If all the products were returned, you really wouldn't have a business. Who would buy from you if all your products were returned, right? But a certain percentage of them will be returned. And actually, businesses have a good idea for the defects in the products that they're selling to you. I know it's kind of a shock, isn't it, that businesses are selling defective products? But no, that's a part of what they do. They can't have 100% first quality when they sell you a product. That would mean there would be no errors in manufacturing, and that is just impossible to accomplish. So we know there's going to be something wrong with some of our products, and we may make a statement that if something goes wrong in a year, you can return it. So therefore, whenever we have a sale, we have to say, you know, maybe the sale won't be returned, but if I have 100 sales, maybe one of those items of those 100 will be returned. And you can see how you can come up with an accrual or an estimate of what the customers will return. And so you use your past warranty expense, your past history for it, and look at how many products you sell, how many are returned, to come up with an idea when you have the sale, how much is going to be returned. So one of the main topics, or one of the main concepts here with this accrual liability is matching. In this case with warranties, if you have a sale, there should be a matching expense recorded that's going to estimate what's going to be returned. And of course, since a journal entry, is going to record both the expense, which flows through the income statement, and the liability, which flows through the balance sheet, you are creating a liability. And so these are types of accrued expenses. And I'm going to make that distinction because in some textbooks it shows it as a contingency. And a contingency and accrued expense is different. Accrued expense is, again, something you would see happening within your business, typically what your business does. You know, and we had salaries expense, we had rent expense examples previously. Now, customer deposits and gift certificates. These are not accrued expenses. These are not contingencies. They are totally different things. But this is when you get cash coming in and you're going to credit a liability when you do it. So typically you debit cash and you credit a liability. And then when you return the deposit to the customer, then you need to remove the liability. I will handle each of these a bit separately. Customer deposits. I have talking to my students in previous semesters. Most of them have experienced the utility company requiring a deposit before their service is turned on. It can be $100. Somewhere I lived, it was $180, which seemed excessive. But they want to make sure that they have some assurance that you are going to be making your payments on your utilities. So they require you make a deposit. So you make a deposit. Well, how does that utility company handle it? Is it revenue? It's not revenue. It is recorded as a liability. It is recorded as an amount which is owed. If you're in the banking industry, I usually have some students every semester who work at a bank or a financial institution. And those students, I say, what about the customers' deposits? The people, customers coming in and they put money into their checking accounts. Those are amounts that are owed to the customers. The bank is holding on to it and using it to make loans or for their reserve requirements, but yeah, it's a liability. To the bank, it's a liability. So deposits, any type of deposit here, is considered to be a liability to that entity. And then when it gets returned, you're going to take it out, usually giving back the cash to the customer. Sometimes they deduct that cash from a bill or something, so that's a little different type of journal entry. If a person walks away from a deposit, what happens? Well, it says here forfeited deposits are recorded as revenue. What typically happens is there's a state record in most states of amounts that customers should have claimed and don't claim, and you can go in and you can claim it. And you may have seen these lists that are published in the paper. So they do get recorded as revenue, but only if the state law allows it and only if the customer has not claimed it. Gift cards. These gift cards are interesting. We'll talk about it extensively, and we have some interesting problem on gift cards. Revenue gets recorded whenever the gift card is given up. It's not when the gift card is sold, it's when it's given up. So when a gift card is sold, the company owes a liability to the holder of the gift card. They owe a liability to the holder of the gift card. And they don't keep track usually of who is the individual who is holding that gift card. They may keep track of the person who bought the gift card, or they may not. Generally, the person who buys a gift card needs to keep their own records to prove they bought it and it hasn't been used in case it gets lost. So the time it's sold, though, it's not sales revenue. It's a liability. And these we typically call deferred. We call them deferred because what's going to happen is the gift card will get used up. And when the gift card is used up, what does it get recorded as? It gets recorded as a sale. Okay, so it becomes revenue later on when the gift card's given up. And in certain jurisdictions, there's some legalities associated with lists like the customer deposits. The companies must remit the unearned gift card revenue to the states. And in other jurisdictions, the gift cards, if they're not used up, become revenue. So it's a little tricky here because you have to follow the law. And in this class, I'm going to let us assume that the gift cards do become revenue after a period of time when they aren't used. Notes payable. Now, technically, when you have a note payable, which is a financial instrument, you need to use time value of money concepts. There is a separate page within the module that talks about time value of money. So if you've had business finance, you'll be in great shape here. But when we record a note payable, we need to record it at its present value. And the present value we record is the present value of all the streams of money associated with the note payable. That means it's the present value of the interest payments. That means it's the present value of the amount of the debt that needs to be paid back. And in this chapter, we're talking about current notes. And these current notes, I'm not talking about a portion of long-term notes payable that's current. I'm talking about the entirety of the note being due, for our purposes, within a year. Okay? If that whole thing is due within a year, then we don't do present value calculations. Now, if we have one of these things, these current note payables, so we aren't doing present value calculations on, then if it does not pay interest, so it's a non-interest bearing note payable, that's the terminology for 0% interest, we have to calculate how much interest there should be on the note. And the reason why we are doing this is because of the concept of a fair transaction between the parties. The thinking here is that if I buy something from someone and they record a liability, they record a receivable in that case. Of course, on my side, I would have the liability. They would have the receivable. It would be inconceivable that that party that I am buying from wouldn't really charge me interest. It's just inconceivable. Because businesses do not function that way. They do not function in a way in which there's no interest involved in a clear loan like that. It's just illogical. So we have to come up with an interest part. And that amount, that transaction, that sales transaction, yeah, really, a part of the value in that total transaction between the parties should be interest. They should be making enough of a return. The seller should be making enough of a return on selling that product that really part of it is interest. So whenever we have non-interest bearing, we have to say it's a misnomer. It really doesn't exist. And the interest part we can't come up with by multiplying and seeing something in front of us that says this cash payment is going out or going to be paid. Instead, we have to look at the whole transaction and we have to say, a part of that transaction is probably interest, and then we have to come up with that amount. And when we do our journal entries, you will be seeing this showing up in an account that's called discount on note payable. So that's a new concept perhaps to you. And we issue a note, and here we're going to start going through some problems. And here we have a note that's issued for cash. So you can figure out, well, what that journal entry is going to be just based on that top line. I mean, we're going to get cash, right? And we're going to have a note payable. And in this transaction, you're going to pick out the important numbers. There's 700,000 there. And a 6 months, so you're going to say 6 months, it's going to be current. And it's going to be 12%. A note about this, a note about the note, right? Interest, when we show it this way. When the problem shows 12% interest, and it's a 6-month note, the 12% you should imply as being the annual rate. So whenever I give you rates of interest, it's an annual rate. So it's not 6%, it's not 12% interest that's being paid, it's going to be 6%. So you can do quick math on this, and 7 times 6 is 42, and you can come up with the amount of the interest that's going to have to be paid, right? And that's going to be $42,000 in total, right? In this particular instance, we call this amount stated. This is the stated interest because it's interest that's in the document, which is a legal document, and we use the term stated. So it has 12% stated interest. That's the annual rate. For 6 months, we would be paying half of that, or 6%, and 6% times the 700. There's a number of ways we can calculate this interest, and I find students do it differently, maybe in finance classes than in accounting classes, and some accounting teachers do it differently. I don't care how you do it, as long as you come up with what amount, right? 42,000. So doing the journal entry, we already alluded to the simplicity of this one, is that on the first date, we have the note coming on board for the total of 700,000. And when we record this note payable, the note payable represents the liability. That is the amount we're going to have to pay. There's no present value calculation here because this is a current liability. Now the second one is truncated. I apologize again for this recording. That's a software issue. The interest expense, you could say it's going to be half of 12, which is 6% times 700, or you could do it this way and say 700,000 times 12% times 6 12s, and do the math, and you can 12s cancel out, which means it's 6 times 700,000, and it's a 0.0 something, 0.06, I guess, times 700,000, and you get to 42,000, right? Yeah, that's the interest expense. So at the end of the term, after the 6 months has passed, and it's always best if you do this by writing down the months and then looking at it that way. So M for May, J for June, J for July, etc. And write it down, count out the 6 months. That's always the best approach. You do that, you get up to November 1st, and they're going to have to pay back not only the 700,000 but the 42,000. And so the bottom line here is a credit for cash for how much on November 1st? Yeah, you're right, 742,000. An astute person's going to say, wait a minute, don't we got some accrued expenses associated with that interest? And I'm going to say, yep, we do. So if you did your financial statements in between May 1st and November 1st and you put them out, you would have to record part of that 42,000 in interest expense and part of the 42,000 as an interest payable, which is an accrued expense. But this is the simplicity of it, and we are assuming there's no financial statements done between May 1st and November 1st. Jamal borrowed $100,000 on July 1st, 2016, signed a 4-year note bearing interest at 8%, and the interest is payable at maturity on June 30th. So this is an important point we need to make also when we start working these financial instrument problems. You notice on the previous one, we kept it for, it started on July 1st, and therefore if this was been done in the same way, we would have had maturity July 1st, right? And not June 30th. I'm going to tell you when you work through your problems, use the numbers interchangeably. That is to say, if you see June 30th, say it's July 1st. If you say July 1st and it needs to be June 30th, use June 30th. So at the end of the month, if you're between, say, the 31st of August and September 1st, and your beginning number is September 1st, just use September 1st for the ending number. If the first number is August 31st, use your maturity for August 31st. It's a little loose in this textbook about those dates. Don't be put off by it. They want to know how much to accrue. So now we're going to get into the accruals. We're going to get into the financial statements. And we are going to assume in this class that we have the fiscal year end of December 31st. This may or may not be the case. Okay, in businesses, in particular in retail, their financial statements year ends are not December 31st. What happens at December 31st? What happens around December 31st in retail? We have a lot of transactions going through, so it will be a nightmare. In retail, which is the area where I worked, I can tell you, you're more likely to have a February or March year end. In this class, just like the convention, which is a way of doing things, I said, 12 months. Is the point, current versus non-current. I'm going to say in here December 31st, you're going to assume that's the year end. Okay, and again, it's not. It depends on the business. So they're saying in this problem year end. Okay, year end, or they're going to do a financial statement on December 31st. They want to know how much interest they should record from July through December 31st. Now, if you do a shortcut on this and you say you're just counting months, you might have a problem, because what you need to see in this, it's all the month of July. It doesn't start at the end of July. It is all the month of July. So you have July, August, September, October, November, and all of December. So you got to count it that way. If you want to put it on your piece of paper and say J, J, A, S, O, D for the first letter of each one of those months, and then count them up that way. That's what I typically do when I'm working on paper. It's very helpful. If you do a shortcut and you say July 31st and then go to December 31st, you would be counting August, September, October, November, December, which is 5 and not 6, and you would get it wrong. So figure out what's easiest to do there and do it consistently this semester. Otherwise, you will get the wrong answer. So it's 100,000, and that interest is 8%. That interest, again, is note bearing. Another terminology we're going to use is stated. Stated interest, 8%. That's a year. So 8% a year, here's the calculation. And for half a year is the same as 4%, right? And that is 4,000. So different ways of doing it. And if you want the journal entry, it's interest expense and interest payable, right? Now, I'm going to talk about that interest payable though. When are they going to pay that interest? Is it going to be soon, or is it going to be in the future? It's an accrued liability. Is the accrued liability current or non-current? Yeah, I wish I could hear your response, because it's non-current. It's going to be on June 30th, 2020. Golly, right? That's probably what, 3.5 years out. So yeah, an example of an accrued liability that is non-current. Ooh, looky up here. Interest, non-interest bearing note. In other words, if someone asks you what the stated interest is on this note, it's going to be what? It's going to be zero. There is zero. And again, as I said earlier, who in their right mind would loan something to some amount of money? Here it's $700,000 and not get interest. So what we're going to have to do is we're going to have to calculate how much of the $700,000 is interest and how much of it is just the loan to the people. And the shortcut, the way we do it in this chapter, since we don't use present value calculations, and it's going to be very different in our next chapter, in our next module, is to do a multiplication to come up with the amount. Okay? And I'm going to say that do not do this when you get to non-current notes or non-current liabilities that are of financial nature. Notice here there's a 12% discount rate. When you see discount in it, it didn't say 12% interest rate. It says 12% discount rate. When you see that word discount, it's probably non-interest bearing, okay, which means it has no stated, which means you're going to have to calculate it. And when you do your initial recording, you're going to have to figure out how much of the $700,000 is interest and how much it is at the liability. You have to figure this thing out at the very beginning. When you have your interest-bearing ones, you can go a time. You can go up until the time in which you're doing your financial statements before you make that calculation of how much interest it is to do a journal entry. This one, you have to put the interest in your books at the beginning. So you recognize in the journal entry the interest. And the caption for that is going to be a discount. So here we go. We are going on May 1st. And you know the amount of cash which you know the amount here of how much you're going to pay back at the end of the 6 months. Because you borrowed how much? $700,000. So you know the amount you're going to have to pay, the cash you're going to have to pay in the future. When you have these problems, you have a liability. That liability, it says payable. Whenever you see payable, it means cash. You're going to have to pay cash of $700,000 in the future, and it's non-current, right? But when we agree to pay, Affiliated Technologies agrees to pay $700,000 in the past. First Bancorp is going to say, yeah, you can pay me $700,000 in the past, but I still want interest. I want to pay paid interest. So instead of paying interest in the future as an interest expense item like we had in the previous example, they're going to cut it out of the amount they pay us in the beginning. They are not going to give us the full $700,000. So here we are, Affiliated Technologies, and we go to the bank and we're going to borrow $700,000. They say, okay, you're going to agree to pay back $700,000 in the future. But today, I'm not going to give you the full $700,000 because you aren't paying interest. Instead, I'm going to take my cut of the interest and I'm going to pay you less than $700,000. I'm going to take the interest out of it up front. Now, when you think about this, this is really an interesting thing because the bank is trying to reduce their risk, but that they will be out both the interest and the liability. Okay, they're going to hedge their bets here, and they're going to take the interest out automatically up front, so they don't have to rely on you and pay an interest. they're going to take the interest out automatically. So if you look at the bank's cash flow, what's happening here is they are giving out a certain amount, but they're hedging their bets because they're not loaning out really the total 700,000. They're giving the customer less in the beginning, so they are, as long as the total 700,000 gets paid in the end, they get their interest, right? And they get the interest really up front. That's the way I look at it. Now here's the calculation. Sometimes in the PowerPoints the formatting's not great, so that should be 700,000 times 12% times 6/12, so 42,000. So what we're saying here, as I was saying earlier, is when it's non-interest bearing or zero stated interest, you have to assume that part of the 700,000 is really interest. How much is interest? 42,000. How much is really the principal that's being borrowed? 658,000. So in the end though, how much does Affiliated Technologies have to pay back? They have to pay back the total of that note payable, which is the 700,000. So when they pay it back, they will be crediting cash and they will be debiting notes payable for 700,000. You're going to say, okay, well that's fine and dandy. So after 6 months, we get rid of the note payable and there's a cash transaction. But what happens to the discount? What happens to the account balance that has 42,000 in it? And what happens? Does it just stay on the books? And it can't. It cannot stay on the books. Reason why it can't stay on the books is because that discount is associated with the note payable. Whenever we discuss the note payable in the financials, we are required to discuss the discount. Another thing I'll bring to your attention here is the discount on notes payable has a debit balance. So the net value of the notes payable, sometimes called the carrying value of the notes payable on May 1st, the amount which shows up, and carrying means on the balance sheet, amount it's carried at on the balance sheet, is 658,000. It's carried on the books at 658,000. We have two accounts that represent this transaction with the note. We have a note payable and a discount on note payable. We cannot talk about one without the other. They always have to go together. They always have to get presented together or discussed or disclosed together on our financial statements. And the net amount of the note or the carrying value then is 658,000 on May 1st. But I'm going to go back to the logistics, the technicality of the whole thing and doing the journal entries. You created a note payable. It's easily you can see that it's going to go away when we pay the 700,000. We have to make the 42,000 go away. When we get rid of the note, we need the discount to go away. These two things walk together. They are together throughout their existence in our financials. We can't get rid of one without getting rid of the other. So, it's like equipment and accumulated depreciation equipment. You gotta keep those guys together, right? You can't get rid of a machine without getting rid of its accumulated depreciation. Same thing here. You can't get rid of one of these things without the other. So now we've set ourselves up. Briefly, discount on notes payable is calculated a simplistic way. Do you not see that? 700,000 times 12%, which should be the interest rate that we, Affiliated Technologies, would be paying, is multiplied by the number of months to come up with this number. That is not the way we do it in the next module. Now, here we are. We're going to pay it off. Okay, so I said we got to get rid of the discount. We do. And it's easy to see that 700,000 going away because it's a cash transaction. How do we get rid of this? Discount. What is it? What really is it? We have to answer is, what is this discount? What does it represent? And here's you getting into theory. It represents interest expense we would have paid if it had been a fair transaction. A fair transaction would have had it being an interest-bearing note. That is a fair transaction. So the true value, if you will, of this whole transaction should include interest expense, and it should record a liability. And the liability that we initially record should be note payable minus discount, or we are really saying that the total amount of the note payable is $700,000 is conceptually wrong, because really the liability needs to be made smaller, which it is, and it gets down to $658,000 in the beginning, and the interest needs to show up there somehow, right? So this whole way of doing things that you have in front of you has to do with theory, okay? The 42,000 represent interest expense that should have been paid that wasn't paid. We can't call it a payable because we're not ever going to pay it in cash. Therefore, we put it in this account, call it discount on notes payable, and then the discount goes away. The expression for this is called amortization of discount, because the discount needs to go away. The total amount of that discount needs to go away by the time we get to November 1st. So again, I'm going to go back and I'm going to talk about accrual accounting, because if financial statements are done in between May 1st and November 1st, what would you have to do? You would have to record a debit to interest expense and a credit to discount on notes payable. This is an easy example for me to talk about, because in 6 months' time we need to get rid of 42,000. So how much would we get rid of in each month? 7,000. So although they have one journal entry here with interest expense, discount on notes payable for 42,000, if you did financial statements every month, you would need to do a debit to interest expense of 7,000 and a credit to discount on notes payable for 7,000, right? And you could make the same, talk the same thing about if you did quarterly financials. So depending on when you do your financials, you need to accrue. You have to do an accrual type entry. And this removes the discount on notes payable. And this is not usually called accrual, though. It's because we aren't dealing with payables. We tend to call it amortization. You're accruing expense, but the effect of this, we tend to call this journal entry amortization of discount. That's the terminology I'll be using. Okay, now effective interest rate would tell us then that if our interest amount is 42,000 and the amount of the liability, which technically we got to borrow because we've split up the 700,000 into the liability and interest. If you put the 42 over the 658, you're really paying 6.38% interest. And if you looked up here and you said 12% for 6 months would be 6%, you realize that whenever you work through these problems and you have a non-interest bearing note, which is one without stated interest, this is a rule which always exists. Your effective interest rate will always be greater than the discount rate. Okay? Yeah, effective interest rate is always going to be greater than stated too, because stated is going to be what? A non-interest. Right, 0. Yeah, and the calculation at the very bottom that you can't see, they said, what is that annual rate then? Well, it's double the 6.38, right? Because 6.38 was for 6 months, then double that. Okay, and that's 12, it'd be 12.76 versus 12%. So effective interest is always greater on non-interest bearing. How do we calculate this again? So we have a non-interest bearing note, 10%. And it's nice numbers here because it's a year. So 10% times 100,000 be 10,000. So 10,000 is your interest number that goes on the top. And the bottom number, since you took 10,000 and called it interest, you have 90,000, right? And so when you do this math, you know that rule we just had a while ago that said effective interest is always going to be greater than the discount. See, the problems oftentimes have the wrong words because what is stated on this one? If it's not interest, there's no stated. It would be 0, not 10%. What word do we need to have in here? Yes, discount. Okay, so we have 10, we have 90, and we do the math and we get 10 over 90, 1/9, 11%. And I said before, this should be greater than the discount. And the discount, yeah, wrong word there, is 10%. Let's talk a bit about contingencies. Contingencies refer to uncertainty about future obligations. To record it as a liability and hence a contingent liability, the first thing to do is, do we have a probable sacrifice? Do we have some sort of a legal obligation? And a lot of these do come about because of lawsuits, so it implies there's a legal obligation. And there has to be something that happened in the past, a past event. So a contingency is a particular type of liability. So one of the first things I'll tell you is it, in first place, is it a liability? Okay? Because you can't really have a contingency if it's not a liability to begin with. And it becomes called a contingency because there's uncertainty involved with it. And just because there's uncertainty doesn't mean that you don't record it. You record it when you determine that there's a likelihood of a loss occurring. In other words, you believe it's going to happen. And my common terminology that I keep referring to on that is, if you are a betting person, would you bet on it? You know, would you really believe it's going to happen? It doesn't have to be 100%. It's just like, do you really believe this is going to happen? If you believe it is going to happen, but you can't really tell for sure, but you just believe it's going to happen. The best experts, by the way, are the ones that make that determination. So if it's a lawsuit, the legal team is going to tell you, what's the likelihood we're going to lose this? Does it look like we're going to lose? And if we are going to lose, the second part about it is, can you come up with a number? Can you come up with a number? So in the first part, if it's likely to happen and it meets the criteria for a liability, you'll do a journal entry, right? And you'll record something like a loss as a debit, and your credit is going to create this liability, whatever caption is appropriate. But can you do a journal entry if you don't have a number? And the answer to that is, it'd be pretty silly, wouldn't it, to do a journal entry with no numbers. So it has to have a number. You have to come up with a number. Again, go to the experts, find out the number. So I've walked all the way around the contingency and not giving you examples. So the examples here, automakers that sell cars with airbags, and the airbags didn't operate. So I think some of you may have heard about that in the news. And there's a potential uncertainty because we really don't know about those lawsuits. We believe they'll be coming, though, because people died, right? One that's fairly recent has to do with plane crashes associated with the Boeing aircraft that had problems. They had stabilizer problems, I believe, so they weren't stable in the air. Oh my, can you imagine? I think hardly anything worse than that, right? An airplane that's not stable. Yeah, you can kind of visualize that. It's, yeah, terrifying. So that creates some problems. And a lot of this is lawsuits. And Philip Morris was a manufacturer of cigarettes and probably still are. And they used to sell cigarettes without telling people that it could cause cancer. In fact, they hid the fact that it caused cancer. So as a result, people died. People died not really knowing that smoking the cigarettes was going to cause cancer. Another thing that they didn't know was that they were addictive, and they should have recognized that, but Philip Morris needs to tell people that it's addictive. Just like a number of items, alcohol has a warning that says it can cause problems if you're pregnant and drinking alcohol, right? So, coffee at McDonald's is another example. Remember the incident where the hot coffee was given and there was a burn, and I think it was through a drive-through, going through a drive-through, the hot coffee spilled and there was a burn incident. So, well, after that, how much is it going to be, right? And so this is the area where you come up with the warning labels on products and stuff. There's all kinds of contingencies, and my best example for that is to think about lawsuits. I really still believe that's the best thing. When you evaluate contingencies, one of the things you need to do then is to figure out if it's probable. And probable means likely, and my word for that is also whether you bet on the thing. Would you take a bet on that thing? It means it's really likely, okay? It's not 50-50. It's the pendulum is far to the right. And don't ask me for a percentage. I'm just going to say the pendulum is to the right. It's just looking like it's going to happen. You go outside and you look at the sky and there's heavy clouds all around and there's lightning in all directions. You say, it's going to rain. I think it's going to rain. You start smelling the rain, right? So that's probable. Reasonably possible means it could happen, and remote means it's not likely. So if you have something that's remote is like, I don't know, the effects of a hurricane reaching us here in Missouri. I don't know. But then if you are in Florida, it's maybe reasonably possible or probable you'll get the hurricane. So all of these evaluations of likelihood are very much specific to your particular examples, to your particular situation. You do not do a journal entry unless it's probable. That's the only time. And then there's rules as far as disclosure. And you probably wouldn't, in a disclosure is a discussion of a thing. So it's not recognition, not doing a journal entry, but whether you talk about it anywhere, in the notes to your financials or any other place. And if it's remote, you probably wouldn't talk about it. You just wouldn't. I probably wouldn't waste my time and the reader's time talking about potential hurricanes that might hit Missouri. I would not do it. So this is the distinction. And if you're in their textbook and you look at page 735, you'll notice that under remote, it says the dollar amount of potential loss, even if it's known, you don't disclose it. And if you can estimate it, you don't disclose it. And if you can't even estimate it, you don't disclose it. But when you look at some of the other ones, like probable or reasonably possible, you notice that you will be at times doing only disclosure notes, and at times you're going to do journal entries. And my rule again is if you cannot come up with a number and it is probable, then you can't do a journal entry. Otherwise, you're going to really be hard-pressed to not record a loss and not record a liability when you have something probable happening. Okay? Now, contingencies. They could go in the other direction. So notice, you got a lawsuit and maybe you're countersuing. So they're suing you, you suing them, and you don't know what the outcome of this mess is going to be. if it looks likely, if it looks probable that you are going to actually win. So instead of having a loss, you have a gain. Even if it's probable, even if you can come up with a number, you do not record anything. It's counter to what you have when you have a loss situation. If you expect a loss, guess what? You have to record it as long as you can come up with a number. So gains and losses are handled different with contingencies. Only probable losses with either known or estimable losses are accrued. All contingencies, except there's a remote, are addressed in the financial statement notes and other places in SEC filings. Liabilities, again, are probable sacrifices from present obligations, real or past events. If you anticipate sales of $10 million next year and you expect 3% of the merchandise will be given back, how is this handled? Is it a probable sacrifice? Yes. Is it a present obligation? It's not an obligation until we make the sale, so we can't say that. Is it a past event? No, we have not yet made the sale. Okay, so it has to have all those three items in place to be a liability. If between the end of the year, when we've done all our financials, and we publish the financials, and the publish of the financials usually happens about 3 months after year end. So if you had a year end of December, which we are assuming all our companies have, we say in March they'll be publishing the financials, go out to SEC reporting. What happens? What happens if we get some new information? So if we have a situation where we have a contingency, and I define contingency, and it's a contingent loss, so it's a liability on our financials December 31st, get some new information after that, we can update the numbers, and we should update the numbers before the financials go out. Even though that's not where we were, December 31st, we looked at it, we thought we had $100,000 in loss. Now in February, we realize it's $200,000. You're required to cause that loss to change in the financials before they go out to the public. So you update. Now, if in December you had no contingency, you have a contingency now in January. Your best bet, you looked at the situation in December, there was no contingency there. Now we got a new lawsuit came about in January, so February, yeah, it looks like $100,000 loss. What do? You ask the question, did I have a contingency at December 31st? No. Well, then you don't have to do a journal entry. Do we have to disclose? Yeah, we're going to have to talk about it, but we don't do a journal entry. So only contingencies that are recognized as of year end, they're losses, loss contingencies at year end, those are the only ones that get updated. The other ones, no. Okay, so this is the end of